From the NASDAQ market site, I'm with Sidhu, Chairman and CEO of Customers Bank, and what an amazing story this is. You took Sovereign to a top 20 bank. You took assets at Customers Bank from $250 million to $3.5 billion. Tell us about the growth strategy.
Growth, I believe that there's no such thing as no growth markets, but definitely there is such a thing as no growth managements. So the growth happens when you have a clarity of your strategy and you identify growth markets and you have a management team that can execute, and there's a focus on superior execution. So as an example, at Sovereign, the strategy was M&A supplemented with some organic growth and geographic expansion. Now these days, we believe the strategy is to take advantage of certain niches. And you've got to do few things really well rather than do things mediocre way, lots of them. So what Customers is doing is we've identified 3 high growth, superior credit quality niches. And we've attracted a team of some of the best people in the country. And we are just executing on those. And I'll tell you what, there is no limit to our growth potential when we can do those kind of things.
Well, it's certainly being recognized, because even Jim Cramer this morning mentioned it on the opening bell on CNBC, that the group is certainly undervalued, but in particular calling out Customers Bank, that there certainly is room to grow here. What 3 segments are you focusing on?
Number 1 segment is small, medium-sized businesses. Okay, and that is a segment where you've got to know the market and you've got to have teams that have already done business, because that market itself, that segment itself is not growing, but there's an opportunity where people want to have a relationship with people who they know and who they think understand their business and who can help them grow. So we've been acquiring teams, not acquiring banks. And that is a trick to grow the small, medium-sized business. Our second segment is multifamily. There is an absolute movement from the suburbs to the inner cities. Okay, and people want to hold real estate in their portfolios. And we are doing business with some of the wealthy individuals, like in New York, who are acquiring real estate, but they have a strategy on how to create value, so that we are protected very much from a credit side of it, and we are very good in terms of turnaround time and understanding what is the strategy of this individual who owns this real estate. If we can combine those two, it's unlimited opportunity. So that's the second growth model. A third one is housing. And housing, we don't like housing to keep it on our balance sheet, because there's a lot of interest rate risk and questionable credit risk still, because we might be in the next housing bubble, who knows when. Okay, so what we do over there is that we finance mortgage companies that are either specialists in refinance or they're specialists in working with builders to buy a home. So we just provide the mortgage warehouse for 2 weeks to them. So we're doing about $2 billion a month of mortgage finance by just holding that on our balance sheet for 2 weeks at a time, where our average outstandings hence are only about $1 billion to $1.2 billion, because it gets paid off every 2 weeks. Those are the 3 biggest niches for us.
So finally, let's get your opinion on the market overall. You mentioned interest rates. They're really low right now, and we obviously want to see them move up a little bit, particularly in the banking world, because it impacts the balance sheet. How sustainable is this low interest rate environment?
I think for the next 12 months, you're going to see low short-term interest rates. There'll be volatility in the market in the medium term and the longer term, because that's directly tied to QE3. And every time there's a rumor about it, the market moves and the slope of the curve moves. Okay, so I certainly don't believe that the Fed believes that the economy is on a strong recovery. They believe the economy is better than where it was, but a 2% growth and 2.1% growth that we had is not a very strong growth. So the chances of short-term rates moving up over the next 12 months are almost 0. Okay, now what will happen 18 months to 24 months from now? I think it will be a very gradual increases, because there is clear evidence as to what will happen in the commodities as well as in real estate if the Fed starts to move very rapidly, even if they're thinking of. So we'll see gradual movement in short-term rates 18 months to 24 months out, but you might see a flattening of the curve, and without having too much of an increase in the long-term rates when that happens, because the long-term rates will move up before that. So I think that'll be the market, the country, and the economy can absorb that. And I think that's what will probably happen. And that you're not going to have shocks in the economy with the Fed moving up. And that seems to be some of the concerns of some of the people.
Right.
But I think it's a very well thought out strategy. And I think in 18 months, you'll see 25 bips at a time, but no more than 2 in a quarter is what will happen.
Well, let's certainly hope that they do it more gradually, because we saw what happened when the bubble burst 5 years ago. So
Yeah.
it's nice to be back on a relatively even playing field. Thanks so much for joining us, Jay.